They told you the move was over. They said Friday was the peak. They said smart money had already left the room. But while the world slept, the market made its decision. When the week opened, there was no hesitation, no pullback, no fear. Silver didn't ask for permission. It jumped. Not the kind of move that comes from optimism, the kind that comes from urgency. Because normal markets don't move like this. They don't surge in silence. They don't climb when liquidity disappears. This wasn't enthusiasm. This was pressure. Somewhere behind the screens, positions were cracking. Risk models were screaming. And traders who thought they were safe on Friday realized they were trapped on Monday. Every dollar higher wasn't profit. It was pain. Pain for anyone who bet against the metal. Pain for anyone who assumed control still existed. Now we're hovering just below a number that changes everything. A number that flips algorithms. A number that turns resistance into fuel. This isn't about silver anymore. It's about what happens when confidence breaks and the exit gets crowded. Because once this door opens, it doesn't close quietly. They said the move was finished. They said Friday was the top. They said smart money had already left the building. But markets don't listen to opinions. They respond to pressure. When Asian trading desks opened Sunday night, something felt wrong. There was no hesitation, no dip, no testing of support. Silver didn't pause to ask if it was too late. It jumped. In market history, that matters. Because commodities don't move 3% in a single session without a catalyst. Oil needs a war. Gold needs a crisis. Silver needs stress. And stress was everywhere. Within the first hour of trading, price surged nearly $2 full, from the mid-60 centile range to just under $69.50. That's not enthusiasm, that's urgency. According to market microstructure research by Albert Kyle, liquidity vanishes first during stress events. Prices don't rise because demand explodes. They rise because sellers disappear. And that's exactly what happened. This wasn't a trade. It was a liquidation sequence. Short positions built on Friday were suddenly underwater. Risk models updated. Margin thresholds tightened. Phones started ringing. In modern markets, margin calls don't come with conversation. They come with deadlines. Usually 24 to 48 hours. Sometimes less. By Monday morning, those deadlines arrived. Banks and funds that sold paper silver contracts were forced to act, not because they wanted to, because they had to. This type of buying has a signature, market orders instead of limit orders. No patience, no negotiation over cents, just execution. Market historian Peter Steidelmeier, creator of Market Profile, described this as time-based panic, when time becomes more valuable than price. And that's what the tape showed. Green candles with almost no lower wicks. Pullbacks measured in pennies, not dollars. Every small dip absorbed instantly. That's how you recognize a forced buyer. Retail waits for confirmation. Institutions usually scale in. Only trapped participants buy like the clock is ticking. Because it is. By mid-session, silver printed near $69, $40, a level that shouldn't have been reachable on a quiet Monday. Yet there it was. And then something even more important happened. Price didn't collapse. It hovered. That pause wasn't weakness. It was compression. In physics, pressure builds when energy has nowhere to go. In markets, it's the same. The failed sell-off sent a message. Friday's attack didn't work. The suppression attempt failed. And when a market refuses to fall on bad news, it's telling you something important. The reversal wasn't random. It was structural. And once that kind of reversal begins, it rarely ends quietly. Because the first move is just recognition. The real move comes next. And the clock is already running. Short selling only works when time is on your side. You borrow, you sell, you wait. And every hour that price stays flat or drifts lower, confidence grows. That's how short positions feel safe, until they don't. What happened after the Monday reversal wasn't sudden. It was mechanical. The moment silver refused to fall back below its breakout level, the trap began to close. Short sellers depend on liquidity. They need willing sellers at lower prices so they can exit quietly. But liquidity doesn't disappear evenly. It vanishes first at the edges. As silver climbed through the high 68 range, offers thinned. Order books that looked full on Friday suddenly felt hollow. That's when psychology shifts. A short position isn't dangerous because of price alone. It's dangerous because of speed. Every dollar higher increases losses. Every minute delays escape. And every failed pullback removes one more exit. By late morning, the market entered what traders quietly fear most, a one-way tape. Price kept moving up, but volume didn't spike dramatically. That's the tell. Real bull markets attract new buyers. Short squeezes force old sellers to chase. This wasn't excitement, it was urgency masquerading as momentum. Risk systems don't care about narratives. They respond to numbers. As silver climbed, value at risk VAR limits were breached. Hedging models adjusted. Collateral requirements increased, and that's when the emails go out. Reduce exposure, close positions, meet margin. For some funds, this happens automatically. Algorithms convert short exposure into market buy orders without debate. No discretion, no delay. This is why squeezes accelerate. Every short that exits becomes a buyer. Every buyer pushes price higher. Every higher price forces the next short to exit. It's not a rally, it's a chain reaction. By early afternoon, silver was no longer trading on fundamentals. It was trading on positioning, and positioning is ruthless. The most dangerous moment for a short seller isn't the breakout. It's the realization that the breakout didn't fail, because now the trade has only two outcomes: exit at a loss or hope. And hope is not a strategy. As price stabilized near session highs, something critical happened. Short sellers stopped pressing. That silence mattered. In healthy markets, sellers test highs aggressively. They defend levels. They push back. Here, there was hesitation. And hesitation is expensive. Every minute spent above resistance normalized the new price. What felt overextended in the morning felt acceptable by afternoon. That's how traps finalize. The short seller doesn't panic all at once. They wait. They rationalize. They assume tomorrow will bring relief, but when tomorrow opens higher, the exit gets narrower. By the time silver approached the upper $69 range, the trap was fully sprung. Not with headlines, not with explosions, but with quiet, relentless buying from traders who no longer had a choice. And when markets move because choice disappears, they don't stop where logic says they should. They stop where pressure finally breaks. And that pressure was still building. Markets are built on numbers, but they are ruled by round ones. $69 is just another price. $70 is a statement. It's not logical, but it's universal. Traders don't react to 69.42 the way they react to 70. Algorithms don't treat them the same. Risk managers don't either, because $70 isn't just resistance, it's a trigger. As silver crept into the high $69 range, behavior changed. Volume didn't explode. Volatility compressed. That combination is dangerous. When a market approaches a major psychological level quietly, it means two things are happening at once. Sellers are backing away. Buyers are waiting, not leaving. This is where discipline breaks. Institutional desks began recalibrating exposure, not because fundamentals changed, but because perception did. Above $70, silver no longer looks like a trade. It looks like a problem. Risk committees understand this. Once a commodity crosses a widely watched threshold, it invites attention. Headlines change tone. Analysts revise language. Media stops asking if and starts asking how far. That shift alone brings new participants. But the real acceleration doesn't come from humans. It comes from machines. Modern markets are layered with conditional logic, breakout confirmation algorithms, momentum triggers, volatility, expansion models, CTA, and trend-following systems. Many of them don't activate at 69.80. They activate at 70 Moore. Not approximately, exactly. Because code doesn't feel, it executes. Once price trades cleanly above that level, even briefly, entire classes of strategies flip from neutral to long. Not partially, fully. And when that happens, supply disappears again. The first push toward $70 wasn't driven by belief. It was driven by necessity. The second push will be driven by participation. That distinction matters. Belief can fade. Participation compounds. Another factor makes this level especially unstable: optional exposure. Open interest in silver options clusters around round numbers. Strikes at $70 carry disproportionate weight. Market makers who sold those contracts hedge dynamically. As price approaches the strike, they buy futures to remain neutral. This is called gamma pressure. It doesn't care about news. It doesn't wait for confirmation. It reacts to math. The closer silver gets to $70, the more buying is required to maintain balance. That buying pushes price closer still. A feedback loop forms, and feedback loops don't unwind gently. At this stage, pullbacks become shallow and brief. Not because demand is infinite, but because supply is afraid. Who wants to sell just below a breakout everyone is watching? That hesitation is the wall cracking. By the time silver trades at 69.90, the market is no longer debating direction. It's bracing for impact. If price fails, the rejection will be violent. But if price holds, the break won't be loud. It will be fast. A quick print. A sudden surge in volume, a line crossed, and then the narrative changes. What was overbought becomes confirmed. What was speculative becomes structural. And anyone still positioned against it is forced to make a decision under pressure. Because above $70, silver isn't just higher, it's uncontained, and markets don't regain discipline easily once that happens. They overshoot. They always do. Most people think markets move the most when everyone is watching. The truth is the opposite. The most violent moves happen when no one is at their desk. Holidays don't shut markets down. They hollow them out. Trading floors run on skeleton crews. Risk desks are understaffed. Decision makers are harder to reach. Liquidity doesn't vanish all at once. It thins. And thin markets behave differently. On normal days, price is absorbed, orders collide, buyers meet sellers. But during holiday sessions, there's space between trades. Gaps form where resistance used to be. This is where pressure turns into motion. As silver hovered near critical levels, the calendar mattered as much as the chart. With fewer participants willing to take the other side, even modest buying had an outsized effect. It's not about volume, it's about depth. A single aggressive order in a thin book can move price farther than 100 cautious ones in a crowded market. And forced buyers don't negotiate. They don't wait for perfect conditions. They execute when required. That's why holiday rallies feel unnatural. Price moves faster than sentiment, faster than headlines, faster than consensus can form. By the time most traders notice, the move is already established. There's another layer to this dynamic: risk aversion. During low liquidity periods, professional traders reduce exposure. They don't initiate new shorts. They don't fade momentum. They step aside. And stepping aside is a form of permission. When resistance isn't actively defended, levels don't break. They dissolve. Silver didn't need explosive demand to push higher. It only needed absence. Absence of sellers. Absence of confidence. Absence of conviction on the short side. Each incremental uptick forced another reassessment. Do we add risk before a holiday? Do we hold into a thin session? Do we want exposure when oversight is reduced? Most answers were no. So offers were pulled, and every pulled offer tightened the vacuum. This is how thin markets magnify moves that began elsewhere. What started as a structural squeeze transformed into momentum without resistance. There were no dramatic news releases, no emergency announcements, just quiet screens flashing higher prices with less effort required each time. That quietness is deceptive, because in thin markets, volatility doesn't announce itself early. It arrives suddenly. A small push becomes a gap becomes a breakout becomes the new reference point. And when full liquidity returns, price doesn't reset, it re-anchors. Traders coming back from the holiday don't ask where silver was last week. They ask why it's here now, and then they adjust. That adjustment is rarely immediate selling, it's revaluation. What looked expensive before the break now looks established. What felt risky now feels inevitable. That's why thin market moves are so dangerous to fade. They don't offer second chances. By the time participation normalizes, positioning has already shifted. Stops are hit, models update, new baselines form. The vacuum closes, but the price remains higher. Silver didn't surge because of celebration. It surged because of absence. And absence in markets is one of the most powerful forces there is, because when nobody is there to say no, price keeps moving until someone finally does. And at these levels, that someone was running out of reasons. Markets like to pretend they are rational. They aren't. They are emotional systems wrapped in mathematical clothing, and nowhere is that more visible than when humans and algorithms collide. As silver pushed into historically sensitive territory, two very different forces were reacting at the same time. Humans hesitated. Machines accelerated. For discretionary traders, fear arrives early. It shows up as second guessing, as hesitation before clicking sell, as the quiet thought that maybe this move isn't done yet. Algorithms don't have that moment. They don't feel pressure. They don't feel regret. They don't remember the last top. They execute conditions, and many of those conditions were now active. Momentum thresholds were breached. Volatility filters flipped. Trend confirmation models turned green. To a machine, none of this is dramatic. It's procedural. If price holds above a defined range for a defined time, exposure increases. If volatility expands without reversal, position size adjusts. If resistance becomes support, bias shifts. No debate. This is why late-stage rallies feel unnatural to human observers. Price moves without narrative, without warning, without sympathy. Human traders try to interpret meaning. Algorithms respond to structure. As silver consolidated near its highs, human behavior became defensive. Short sellers reduced size instead of adding. Longs hesitated to take profits too early. New participants waited for confirmation that never came. That waiting mattered. While humans paused, machines accumulated. And because algorithmic participation doesn't require conviction, it doesn't require comfort either. If conditions remain valid, buying continues, even if price feels stretched. This is how emotional resistance erodes. Human traders rely on reference points. It's gone too far. It should pull back. This level won't hold. Algorithms don't care what should happen. They only know what is happening. And what was happening was simple. Higher highs, higher lows, failed breakdowns. Each failed attempt to push silver lower strengthened machine confidence. At the same time, fear evolved on the human side. Not panic, yet. Something more dangerous. Uncertainty. Uncertainty keeps traders frozen. It delays decisions. It creates missed exits. By the time fear becomes action, price has already moved. That delay is where algorithms thrive. They don't wait for clarity. They define it. Once a trend is identified, participation increases automatically. That's why the tape felt relentless, not explosive. Relentless. No dramatic spikes. Just constant upward pressure. This wasn't a frenzy. It was a transfer of control. Markets always choose who leads. In the early phase, humans dominate. In the late phase, machines enforce. As silver crossed levels that triggered system-wide adjustments, something subtle happened. Volatility became one-sided. Upside moves expanded, downside moves compressed. That asymmetry is the fingerprint of algorithmic dominance. It tells you price is being guided, not debated. Human traders sensed it, even if they couldn't articulate it. They stopped fading strength, they stopped pressing weakness. And when humans stop challenging a move, algorithms don't slow down, they scale. This is the phase where headlines lag price, where explanations arrive after the fact, where confidence shifts too late to benefit. Silver wasn't rising because people believed in it. It was rising because the system had accepted it. And once acceptance happens at the machine level, reversal becomes much harder. Because emotion can change in seconds, but code only changes when structure breaks. And at this stage, structure was still intact, very intact. Every market move reaches a moment where direction is no longer debated, not because uncertainty disappears, but because reversal becomes too costly. That moment doesn't arrive with fireworks. It arrives quietly. For silver, that moment was approaching fast. After the squeeze, the psychological barrier, the liquidity vacuum, and the algorithmic takeover, the market entered its most dangerous phase. Not the beginning, the commitment. At this stage, positioning matters more than opinion. The question is no longer, is silver overextended? It's who is still exposed the wrong way. Because now, exposure carries weight. Short sellers who survived the initial squeeze are no longer confident. They are compliant. They reduce size on minor dips. They hedge instead of pressing. They accept losses they would have fought days earlier. That behavior changes the entire market tone. When sellers stop believing in downside, supply doesn't just weaken, it fractures. Meanwhile, long holders behave differently too. They stop trading. They stop flipping. They start holding. That reduces float. And reduced float during rising prices is combustible. This is where continuation feeds on itself. Every hour spent near highs normalizes them. Every failed attempt to break lower confirms support. Every quiet session adds tension. The market becomes a compressed spring. But there's another force now watching closely. External validation. Once silver sustains these levels, it invites participation from outside the original trade, asset allocators, hedging desks, portfolio managers, seeking diversification. These participants don't chase spikes. They allocate on confirmation. And confirmation isn't a candle, it's time. Time above a critical level signals acceptance. That acceptance triggers reweighting. Not aggressive buying, persistent buying, the kind that doesn't stop at resistance, the kind that treats pullbacks as opportunity. At this stage, volatility doesn't disappear. It changes character. Moves become sharper, ranges expand, reactions grow faster. Because now there's more at stake. If silver pulls back, it tests conviction. If it pushes higher, it forces repositioning. Either outcome increases activity. That's why markets near the point of no return feel unstable. They're deciding whether to consolidate and continue, or overshoot and correct violently. But here's the truth few acknowledge. Most markets choose overshoot. Because restraint requires coordination, and coordination is rare. Fear and greed don't average out. They cascade. Silver wasn't isolated from that dynamic, it was primed for it. Structural pressure remained. Liquidity was still fragile. Algorithms were still engaged. Nothing fundamental had changed to relieve tension. That's the warning sign. Markets don't reverse sustainably until something breaks the structure. Not a headline, not a rumor. A mechanism. Until then, continuation is the default. This doesn't mean price rises in a straight line. It means pullbacks become shorter-lived. It means volatility increases, not decreases. And it means participants who wait for confirmation often find it already passed. The point of no return isn't a price. It's a condition. A condition where selling feels unsafe, holding feels logical, and doing nothing feels risky. That's when markets stop asking for permission. Silver was approaching that condition, not because of hype, not because of belief, but because structure demanded resolution. And once markets demand resolution, they don't negotiate outcomes. They force them. Whether that force leads to continuation or chaos depends on how participants react next. But one thing was already clear. The easy phase was over. From here forward, every move would matter more. Every decision would carry consequence, and every hesitation would be punished. Because past this point, markets don't drift. They choose. Before the chaos unfolds, make your move. Click subscribe now. Don't miss the next chapter of this silver saga. Turn on notifications. Every tick matters. Every movement counts. This isn't just a market. It's a story of control, fear, and opportunity. And you want to be in the front row. Comment below, are you holding or stacking? Are you watching the $70 wall crumble or waiting for the pullback? Because the next move could happen in minutes and you'll want to see it live. Remember, the market doesn't wait. Opportunities vanish, but knowledge lasts forever. So subscribe, ring the bell, and stay alert. Your portfolio and your insight depend on it.